Hello, everyone. Welcome to today's NinjaTrader ecosystem event, Trading Trends with Multiple Bar Lengths and Kase StatWare. My name is Patrick Hodges, and I'm a NinjaTrader ecosystem vendor relations representative. Before we start today's event, I'd like to go ahead and give you all a few housekeeping notes. Secondly, this webinar is presented by NinjaTrader LLC, which is the technology company responsible for developing and supporting the NinjaTrader trading software. Brokerage-related questions should be directed to the NinjaTrader brokerage using the phone number or the email that you see on the screen. Lastly, if you are new to NinjaTrader, please make sure to sign up for a free NinjaTrader account, which includes access to 14 days of complimentary real-time market data. Our platform is always free for advanced charting, strategy backtesting, and trade simulation. You can create your free account by following the link that's on the screen and then click the Get Started under the Welcome section. It's important to understand that futures, foreign currency, and options trading contain substantial risk and are not suitable for every investor. It is possible to lose all or more than your initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Also, please remember that these training sessions are not a solicitation nor a recommendation, but simply educational in nature. All right, I want to thank you all again for joining today. And without further ado, it's my pleasure to welcome to the NinjaTrader webinar room, Dean Rogers.
Perfect. Thank you, Patrick. I appreciate it. All right. Good afternoon, everybody. My name is Dean Rogers. I'm a chartered market technician. I'm the senior analyst with Kase and Company. I've been working with Kase and Cynthia Kase for over 24 years now. I started with them in 2000 as a trader, as a programmer, and then learned all about the futures markets, which I had no clue about when I very first started, all about technical analysis, and here we are today. So today we're going to talk a little bit about trading trends with multiple bar lengths using Kase StatWare. Now, what we're going to go over here doesn't necessarily mean that you have to use Kase StatWare or Kase Bars or any of the indicators that I'm going to be showing. These are concepts that you can apply to your own trading indicators, traditional trading indicators like RSI, MACD, stochastic, those kind of things. But we will be using the Kase StatWare trading package that is available on NinjaTrader for the examples. So with that, obviously risk disclosure, Patrick just gave us a good rundown of that. But obviously, the markets are risky. You never want to trade more than you're willing to risk. That is something that we're going to talk a lot about today, and how to try to manage that risk. But trading is a risky endeavor. So, please be cautious, please be smart with your trades and your money. And, we want everybody to be as successful as possible. So just a quick rundown, a little bit of background. Kase and Company was founded by Cynthia Kase. She's also a CMT and an MFTA. It was founded in 1992 by her. She used to be a trader for Standard Oil and Chevron, Chemical Bank, and a couple of others in the 80s and early 90s. Then she started her firm. She became one of the early chartered market technicians with the CMT Association, and has built Kase and Company to where it is today. And like I said, I've had the pleasure of working with her for 24 years now. We have a lot of different services, but the services that we have available on NinjaTrader are our Kase StatWare trading indicators and our Kase X trading indicator. Today, we're going to be using Kase StatWare. That's what we're going to be showcasing. We also have a couple of custom bar types on NinjaTrader. We have our X range bars. We have just newly on NinjaTrader our Kase Bars. So Kase Bars, up to just a couple months ago, had only been available on a couple of other trading platforms, but now we're able to put them onto NinjaTrader as well. So we have them there. Very excited about that. So we'll be showcasing the Kase Bars today. And then we have another bar type that's very similar to the Kase Bars. It works with some of the issues that the 1 minute Kase Bars have. It's called DR range bars. So all of those are also available on NinjaTrader. Some other services that we have, we specialize in the energy and metals commodity markets. So we do weekly and daily forecasts of those markets. We also work with companies, larger companies, on risk management and hedging. Again, there's my email address, so please note it down, dean@kaseco.com, so that if you do have any questions after this, you can send them to me as we're going through the presentation. If you have questions, I will try to get to them as we're going through the presentation. And if I don't get to them, I will certainly address them at the very end. Okay, so on today's agenda, we're going to do a quick rundown of the Kase StatWare entry and exit rules. Now, this webinar isn't really intended to teach you how to use StatWare. We have lots and lots of videos and manuals and quick start guides and examples. We even do one-on-one lessons with those that take a trial. We offer a 30-day free trial. So I'll give you that information at the end if you are interested in looking at the StatWare. But I do want to, for the context of this webinar, to teach you a little bit about the entry and exit rules so that we have a basis for our trading of trends. We're also going to talk about using our risk appetite to determine bar length. If there's one thing that you take away from this webinar today, it is this lesson that risk appetite is obviously very important. We want to manage our risk. That is, in my opinion, a key to being a successful trader. More so than even the entries and exits that we use is managing our risk. Not every trade is going to go in our favor. Not every trade is going to work out. And a lot of traders, to be successful, you have to manage that risk. And a lot of managing that risk comes down to the trading style that you have, but also the bar length that you're using. So we'll talk about that a bit. Then we'll look at setting up multiple bar length charts as a basis for, or a foundation for, trading trends. And then we'll look at entering and exiting trades, scaling trades up through the bar lengths over time as we get the permissions that give us the telling us that we can take more risk, scale our trade to a longer bar length, use a wider stop, and avoid whipsaws as we trade through trends. So the first section here, Kase StatWare entry and exit rules. Again, we're just going to touch base here. If you do have any questions, if they're too detailed, we can get into that a little bit, maybe towards the end. But I want to give you a basis of our Kase Easy entry system. So obviously that's used for timing entries. Our dev stops, which are used as a trailing stop to manage risk. And then our Kase PO and KCD momentum oscillators that give us our exit signals, momentum divergence signals, and then what we call peak out and KCD peaks, or basically they're overbought, oversold signals. So the Kase Easy entry system, it's very simple. It actually does a lot of work in the background. We're looking at multiple bar lengths, we're looking at multiple momentum indicators, and we're looking at bar trend direction. So whether or not bars are closing higher, closing lower, making new highs, making new lows. But all of that information is distilled down into these little color-coded dots, red dots for bars that have short permissions, red or pink, and then either the cyan or darker blue dots for bars that have a long permission. So basically what we're doing is, for instance, when we're looking at, let me get a little pointer here so we can see everything. So for instance, here we have what we would call a second class short signal. So we have our warning signal telling us that the market may start to move down. That's an orange S. Then what we're looking for is we're looking for that pullback, and then that second signal to tell us that we have permission to get short. And what's happening here with this second class short, which is the red dots or the red S, is that the majority of momentum on the chart that we're trading is permission short. So we're looking at 3 different momentum indicators. If the majority of those are short, it's going to get some sort of short permissioning. But then we're also looking at a longer bar length in the background that is 3 times the size of the bar that we're looking at on our chart. If that longer bar length filter is still permissioned long, that's where we're getting the red S or the second class. Whereas over here, where we're getting the pink S or the first class short, basically the majority of momentum on the chart that we're looking at, in this case, it's a micro crude oil 25-cent Kase bar. So the majority of momentum on that bar is short, and the longer time frame filter, that filter that's 3 times longer than the bar length that we're looking at, is also permission short. So that tells us basically the market is trending in our direction, not only on this bar length, but on a longer bar length. So same thing with the long signals. So we have a long warning signal here, the green, and then we have a first class long with the darker blue L. That's telling us that the majority of momentum is long. Longer time frame filter is also long. And then we have the second class. Got a quick question here. Do the S and L appear on the closes of the bars that they print above or below, or do they appear some number of bars later? No, they'll actually appear intra-bar, so they can come on and off intra-bar. So by the time now we recommend that you wait until that bar closed before taking action using the SRL, but they do appear intra-bar and they will appear at that time. There are some signals that could appear, and I'll explain this a little bit later with the exit signals, that may actually appear a little bit later. Okay, so moving forward. Let's see if I can move. There we go. So once we've established an entry, we can go ahead, and it's very important to place a trailing stop. We are big proponents of using a trailing stop to manage risk. So as the market is moving in our favor, that risk or that stop is going to trail the move up or trail the move down. Now, the stops that we use are based upon standard deviations of the average true range over the last 30 bars. So we actually use what's called a double true range, which is basically the true range over 3 bars rather than the 2 bars, but it's a fine point. They're very similar. Now, whenever we're looking at time-based bars, we're going to use a 1, a 2.2, and a 3.6 standard deviation move for Dev 1, Dev 2, and Dev 3. The warning line is basically just the median of the distribution. Now, the reason that we use 2.2 and 3.6 is basically we're accounting for right-hand skew on the bell curve or the distribution of volatility. So again, not going to be able to get into a lot of detail on that. There's lots of information out there, and if you guys are curious about that, feel free to contact me via my email after this. Now, if we're using range type bars, because whenever we're using a range type bar, whether it's a Kase bar, a Kage, whatever it might be, just regular range bars, the DR range, the X range bars, all of those are range type bars. They're bars built upon price movement rather than time. With that, the distribution of volatility becomes more like a witch's hat. So it becomes much more narrow. So in that case, to emulate the same level that we would see with like a 3.6 standard deviation move on a time-based bar, we basically have to double our standard deviations. So at Dev 1, we're using 2 standard deviations. At Dev 2, we're using 4.4. And at Dev 3, we're using 7.2. Okay, so if we are using a range type bar, we do use a larger number of standard deviations, and that's just to account for the much more narrow distribution of volatility on a range bar chart. Okay. And then finally, we have our KCD, which is this indicator here, and the Kase PO. So the Kase PO or Kase Peak Oscillator is very similar. It's a first derivative momentum indicator. It's very similar to something like the stochastic or the RSI. So it's looking at rate of change of price. And then with the KCD, it's something very similar to the MACD. So it's basically looking at the Kase PO less an average of itself, 3-period moving average of itself. With that, we get these different signals. We get these green Ps, which stand for peak outs. That's an overbought signal. Generally, if it's a green P, we're going to exit 50% of our trade and tighten up our stop to Dev 1. So whenever we enter a trade, we usually place a stop at Dev 3. When we start to see warning signals, we'll tighten up our stop to Dev 1. We also have a weak peak out here. So basically, a weak peak out is a peak out. So it's an oversold signal in this case. However, the bar that confirmed, so what we have to see here, this comes back to Brad, this comes back to your question about the L's and the S's. The L's and the S's will appear on those bars in real time on that bar as the bar is forming and then at the bar close. However, with the divergence and the peak out signals, we have to see a swing low in price and a swing low in momentum. And in this case, with the peak out, it has to be oversold. So the P will actually be drawn on the bar, the swing low bar, but that won't actually be drawn until we have both the swing low in price and the swing low in momentum, which are always going to be at least, well, not always. Most of the time. If it's an outside bar, that's not the case. But most of the time, that's going to be one or maybe two bars after that swing low is formed. So for instance, like this divergence here, this is a KCD divergence, this red trend line. So we had falling price with momentum that was becoming less negative, but that wasn't confirmed until this bar when we had both a swing low in price and a swing low in momentum. So we wouldn't have seen this red trend line get drawn until this bar. Now, again, it will draw it intra-bar, and it could turn on and off. Like if this bar made a new low or momentum made a new low, that divergence would go away. So again, at the close of this bar, that's when that signal is confirmed, and that's when we would take action upon it. Okay. So I'm going to move a little bit quicker here because we do have a limited amount of time, and I want to make sure that we get to the good stuff and also have enough time for more questions. So the most popular question that I get, or one of the first questions I generally get when I'm working with traders is, what is the best bar length to trade? You know, they're looking at Kase StatWare. They might say, hey, with Kase StatWare, what's the best bar length? And I think a lot of this comes from people that have developed systems that maybe have optimized those systems on certain markets, certain bar lengths. You know, they might have said, okay, we built this system to it works best on a 5-minute chart on the E-mini S&P 500. And that's kind of gotten, melted into our brains a little bit. There's a best bar length or whatever else. That's not my goal. My goal, or Kase's goal, is we wanted to give you tools. We want to give you tools that you can use. StatWare is not a trading system, so to speak. These are indicators that give you guidelines of when to get in and possibly when to get out of the market, where to place your stops. And they can be integrated into your own trading style that you already have, or your own trading indicators that you already have, to help improve that system or help improve your trading. Or you can use them, out of the box with our default kind of trading rules and guidelines. But really what we're trying to do is you should be able to apply these indicators to any bar length, any type of bar, and in just about any market that's liquid enough to give us, trends and momentum and those kind of things, which is most markets that we're trading, most of the futures markets, commodity markets, foreign exchange, those kind of things, even the equity markets. So really, when it comes to bar length, my answer, and I don't think anybody ever likes my answer, but it is my answer and I stick by it, and I will probably always stick by it, is the best bar length is really based upon your risk appetite. You have to ask yourself, what are you willing to risk? How much are you willing to risk per trade? And that is your maximum risk appetite. Well, that maximum risk appetite is going to help you determine what bar length is going to work best for your trading style and your risk appetite. So we'll get a little bit more into that, but this is a very, very important point. And if you have a chance, check out, there was a recent interview with Leah Holmgren on NinjaTrader Live, which is a show that NinjaTrader does every morning and afternoon. And they have a lot of great interviews on there, a lot of great presenters. And she talked a lot about this concept as well. I thought it was fascinating and it was excellent. So I would definitely encourage you to check that out and check out the NT Live. Those guys, Tom, Jim, and Michael are great. So let's look at how do we determine, using the Kase StatWare indicators, how do we determine how much risk we're taking on any given bar? So we have an indicator called the rev amounts, K rev amounts. And what this does is it shows us how much risk is being taken at Dev 1, Dev 2, and Dev 3 of our Dev stop indicator. So that 1, 2.2, 3.6 standard deviations on time, or 2, 4.4, and 7.2 standard deviations on range type bars. And so this indicator, like for instance, I have the micro crude oil 15-minute chart up here, and it's showing us that at reversal level 3, which is Dev stop 3, so that's our default Dev stop, that's where our maximum risk is. This is a 15-minute time-based chart. So at Rev 3, at one point here was 25 cents, which is about $25 on the MCL contract. Here it was 65 cents, so it's about $65. Here it's $105, or $1.05 is the risk. So about $105 per contract. Now, there's a lot of variation in that, right? So it kind of goes from 25 to 105 here. So one of the things this is one of the advantages, in my opinion, well, not even just in my opinion, just factually here. One of the advantages of using something like a range type bar, specifically the Kase bar or X range bar, DR range bars, and other range type bars, Kagis, all these different range bars that they have out there, is because they smooth the distribution of volatility, because they're basically not time-based bars, but price-based bars. What we end up with is a much smoother distribution, right? We talked about that witch's hat a couple of minutes ago about the distribution of volatility. So here, what we have is a fairly equivalent. This is a 25-cent Kase bar chart. So the Kase bars, the way that they're built is basically we're looking at the average true range. And we have a target. So every time the market hits 25 cents in the average true range or greater, we create a new bar. So as we move along, all of these bars are about 25 cents in size for the average true range. Well, with that, we get a much smoother distribution of volatility. Therefore, our stops are much smoother as well, the distribution of our stops. So here, we look at $88, $78, $96, much tighter distribution than we saw with the time bar. So what I'm getting at here is we can much more reliably look at managing our risk on a day-to-day basis when we're using a bar size that is consistent, such as a range bar like Kase bars. Okay. I know we're moving fast here, but we're trying to get to the good stuff. So now let's talk about setting up multiple bar lengths so that we can trade trends. And Barry, I will get to your question at the very end. So we're going to set up 3 different bar lengths, and I'm going to call these our normal monitor, which is our longest bar length. This is where the maximum amount of risk is. So we're going to have the widest stops here. We're taking the most risk on the normal monitor, but our goal is to scale our trade up to the normal monitor. We don't want to necessarily start off on the normal monitor to time an entry. That's where we want to actually get our trade to and carry it through that trend and then get the exit on the normal monitor. The fast monitor is in the middle. So basically to get the fast monitor, the way that I do it is I want to take about a third less risk than the normal monitor on my fast monitor. So I'm going to divide by 3 if I'm using a time bar. So if I'm using a 45-minute bar for my normal monitor, I'm going to divide by 3. So that means I'm going to use a 15-minute bar for my fast monitor. That'll give me about 2/3 of the risk of the normal monitor. Now this is a bar, and then if we're using a range type bar, because volatility is related to the square root of time. So we can look at, if we're taking about 2/3 or about a third less risk, we can divide by the square root of 3. So if I'm using a 35-cent bar, I'm going to divide that by the square root of 3 to give me my fast monitor. This is a bar that we're going to start to use when the trend is developing. It's helping us to avoid some of the small whipsaws. And then the timing chart, we're going to divide our time by 3 or our range type bars by the square root of 3 to get us down to our lowest bar length. So this is where we have the least amount of risk. It's only about a third of the risk that we're trading with on the normal monitor. And we're going to use it to time our entries and early in potential trends. Now, we might end up taking a couple of trades on the timing chart, getting in, getting out. But ultimately, what we're trying to do is time a trade early during that consolidation phase as a trend is developing, kind of during that wave 1 and 2 or A and B. And then we're going to scale our trade up when we get that impulse move to the fast monitor and the normal monitor. So as an example here, again, I'm using the micro crude oil chart just because I wanted to stay consistent throughout this presentation, but this can be used on anything. So here our normal monitor is going to be 35 cents in size. So I might have to say to myself, hey, look, I'm only willing to risk $150 per contract. That's my maximum risk tolerance. So now, once I've established what my maximum risk tolerance is, I can then back into what optimal bar size I want to use. So in this case, with a 35-cent Kase bar, at one point it was around $142 at reversal level 3. So that's that 3 standard deviation move. Or I guess in this case, it's around a 7 standard deviation move because we're using a range bar. And then over here was about $1.15. So looking at this chart, I know, okay, I'm going to be risking less than $150 if I'm using Kase Dev Stop 3, which is around equivalent of a 3 standard deviation move, the average range over the last 30 bars. Okay. So from there, I divide this by the square root of 3, and that gives me a 20-cent Kase bar. So here we're taking a little less risk if we're using Dev 3. It's only about 70, call it $75 of risk at Dev 3. Then I divide this by the square root of 3, the 20 cents by the square root of 3. That gives me a 12-cent Kase bar. So again, this can be used with regular range bars, the X range bars, the DR range bars, same concept, dividing by the square root of 3. If I'm using time bars, I'm dividing by 3. So here we're taking the least amount of risk. It's only around $39 here at the low point and around 47 at one of the high points. Okay, so now we know we have our normal monitor, our fast monitor, and our timing chart. So now what we're going to get into is how do we use those charts to scale into or enter a trade, scale that trade up over time. So we're going to start off, and it's kind of a common sense approach. So again, like I said, you don't have to use Kase StatWare for this. You could use moving average crossovers. You can use, buy and sell signals that you have from other indicators and use the same idea of these multiple time frames and getting confirmation. So for instance, if I'm using Kase StatWare, I'm going to start off by timing an entry on the timing chart. So that's my 12-cent micro crude oil chart with the Kase bar. I get my long warning signal. We have a small pullback here, and then we get a second long signal. Not an ideal pullback, but it was enough to qualify. So we get our long signal here. It's a first class long that's on September 11th at 9:03 in the morning. We enter the trade at 66.42. We place this trailing stop at Dev 3. So at that point, we have 70 cents of risk or $70 per contract. If I'm trading multiple contracts, that's fine. We just need to make sure that we're staying below our risk limit. We said in this case, it was $150 per contract, but if my total risk was, let's say, $1,500, well, I could trade up to 10 contracts, right? So our position sizing matters as well. Now, as we see this move up developing, we had a peak out, we had a bearish divergence. We would have had a short trade possibly in here that wouldn't have worked out very well. We would have had another short trade in here that was okay, but we had some whipsaw type signals. So there's a lot going on here when we're trading on this timing chart. But as I'm watching, once I get into that trade and I'm watching for exits, so I'm watching my timing chart for exit signals, peak outs, divergences, overbought signals, whatever it may be, dev stop hits. At the same time that I'm watching for that, I'm also watching my normal monitor, or my fast monitor. And I'm watching the fast monitor to see, do I get a confirming buy signal, in this case, a blue or light blue L, to tell me that I can now scale my risk up to this longer bar length. Meaning, and when I say scale risk, I'm not doing anything. I mean, I could add to my position here if I wanted to, but what I have found is it's best to just enter your trade, your maximum number of contracts on the timing chart. When you get the scaling or the signal to scale higher, so in this case, I get a first class long signal at 9:32. So we get at 9:32, we get that first class long signal. That's telling me that now I can scale my risk up to the fast monitor, meaning I can take more risk. So now I'm going to have my risk at Dev 3 on the fast monitor, which is the 20-cent chart. That's 97 cents of risk or $97 per contract. And I'm going to trail that stop. Now this goes out a little bit further on this chart, but you can see that we had divergences that would have gotten us out of this long trade, right? We would have had a short trade here that didn't work out very well. We'd have had another long trade that we rode up, but then we hit Dev 3. So we have a lot of little whipsaws in here going back and forth on the 20-cent chart. Well, the same with the timing chart to the fast monitor. As I'm monitoring the fast monitor for an exit, if I get an exit signal, I get out, I drop back down to my timing chart, I start the process over again. However, at the same time, I'm watching my normal monitor, And when I get that buy signal, now in this case, it's a second class buy signal at 9:37. So 5 minutes later, I get a buy signal on the 35 cent or my normal monitor. I now know that I can scale my risk or scale my trade to the normal monitor, place my stop at dev 3. Now, right now, the dev stops aren't flipped in the right direction, but there's a way that we can manually flip those. And I can now carry my trade on the normal monitor and watch. Now I'm looking for exits on the normal monitor. I've gotten to my goal. I'm at my maximum risk. If I wanted to be a little more cautious, not as aggressive, and I wanted to wait for that first class long signal, I could have waited a little bit longer until 10:34, at which point the risk was around $136 per contract. So again, we're staying below that 150 max that we had kind of put in place for ourselves. Now, in this situation, all of those little whipsaws are avoided. We do have some short. Now, once I'm long, I'm not really worried about these short signals unless I hit my dev stop 3, which is that lowest little dot here. So as we're going up, as the market's moving up, we're just riding that trend. And then eventually we get a bearish divergence. That bearish divergence would have been confirmed right here on this bar where we have the orange S. The red divergence or the KCD divergence was confirmed there. The Kase PO wasn't confirmed until one bar later, I think it was. But at that point, when we see that divergence, we can exit 80% of our trade if we're trading multiple contracts. If we're just trading one contract, I'm getting out. I'm just out of the trade. And then if we're trading multiple contracts and I get out 80%, I go ahead and tighten up my stop to dev 1. So that first blue dot for the remaining 20%. When dev 1's hit, I'm out of that remaining 20%. If the market moved back up and we started making new highs without hitting dev 1 and we start to get new buy signals, I still at least have 20% of my original trade on. I can re-enter the other 80% when we start to get those confirming signals. A little bit of a whipsaw, it's going to happen, but we're trying to eliminate those as much as possible with this technique of scaling to longer bar lengths. Okay, so it's a pretty straightforward idea of starting our trade off on the timing chart. So we start our trade off, we enter our trade, we monitor the timing chart for exits or stop hits. If we don't have any, and we actually get a confirming signal on our fast monitor, we then scale our trade up to the fast monitor. And when we scale up, all we're doing is we're just taking more risk. We're basically moving our stop to dev 3 or widening our stop to dev 3 on the fast monitor. Same process, look for exits, look for dev stop hits. If we don't get those, then we go ahead and scale up to the normal monitor, and then we ride that trend on the normal monitor as far as it's going to take us. Okay. Now that is what we would call a bottom-up technique. So basically, we're timing our trade on the entry chart, we're scaling to the fast monitor on a confirming entry, and then we're scaling to the normal monitor with a confirming entry when we're trading with the trend over the longer term. Now we can also, the challenge or the challenge with the bottom-up technique is that we may get several trades on the timing chart or on the timing that we scale to the fast monitor, and then we get an exit signal and we get out, and then we have to kind of drop back down to our timing chart and re-entry. So we might have, 2 or 3 trades that we take on the timing chart before we're finally able to scale that to the fast monitor and to the normal monitor, right? But the trade-off is those trades that are successful in holding through the trend or being held through the trend, we're going to have a very early entry in the development of that trend. So we're going to capture a majority of that trend. The other technique that we can use to avoid some of those small kind of whipsaw type trades on the timing chart before we're able to scale that up is we can use a top-down technique where we wait for some sort of reversal signal like a divergence or a peak out or some sort of overbought oversold signal on the normal monitor. Then we drop down at that point to the timing chart, and then we start that process of the bottom up where we time our entry, we then scale to the fast monitor and to the normal monitor. So kind of as an example here, if we wanted to use a top-down technique, so top-down, so basically we would look at when we had these divergences here, so once we got those divergences, we're out of our long trade, then we would go ahead, because we had that divergence, we would drop down into our timing chart and then look for an entry. So basically those divergences are telling us that we should see a statistically significant turn. Not necessarily a big enough turn to say that we should get in, but at least that we can drop into our timing chart now and time our entry and then work our way back up. Okay. So with all of this, Kase StatWare, we offer a 30-day free trial. You can get it at our website, kasecco.com, KASECO.com. We've got a big old get a free trial button in the upper right. When you do that, you take a trial. It's 30 days complimentary. We will send you the NinjaScript installer files. If you are on Gmail, there is a little bit of sometimes a trouble with getting the NinjaScript files to you via links and zip files, but we will get those to you. So anybody that sends us or signs up for the 30-day free trial, we will work with you on getting you the trial set up. We also do lessons for those that take the trial. So we'll usually do 2 lessons with you if you would like that. We also have lots of videos and manuals and everything else that we will send to you. So if you're not somebody that wants to talk to us about and go through a live trial or a live demo with us, and you just want to watch videos, we've got plenty of stuff up on our YouTube channel, on our website. We'll send you links to all of that information as well. But if you do want a one-on-one lesson with us, it will usually will be with my cohort, Daniel Kase, Cynthia Kase's son. He will work with you on giving you lessons, and then I'll get involved as appropriate. The other thing that we are offering through the end of this year, so for those of you that have watched this webinar or anybody that's going to watch the replay on YouTube or any other channel where this is distributed, if you are interested after your 30-day trial in subscribing to Kase StatWare, the normal price is $195 per month if you want to do a month-to-month contract or lease or subscription. But we're offering a promotional price. It's around a little more than 25% off. It's going to be $18.95 for 13 months. So it's a very good deal, and that will continue to roll forward. If you'd like to follow us on Facebook, Twitter, or I guess X, YouTube, we've got all of that information there. I right now have been throwing up once a week. On Tuesdays, I do a crude oil, or I throw up put our crude oil forecast for the day up there. So it's a very short-term crude oil forecast. I also put on Wednesdays, I put our natural gas. And on Thursdays, I usually do gold. Every once in a while, I'll do copper. So if you're interested in learning more about that stuff as well, we can definitely, you can get some information. We put them on our blog as well on our website. Okay, so if anybody else has questions, please let me know. Barry, you asked, we appear to concentrate on the oil and metals. So we do concentrate on the oil and metals in our forecasting services. So that's where, we work with clients on hedging, risk management. So big corporate clients. A lot of the institutional traders that we work with are oil and gas or metals traders, with hedge funds or whatever else, banks. So we do, and then we put out weekly forecasts on the crude oil, natural gas, base metals, and precious metals markets. However, as far as the trading indicators are concerned, StatWare, KaseX, anything that we have available in the NinjaTrader ecosystem, that can work on anything. Any of the indices like, the NASDAQ, the E-mini, the S&P, any of those indices, individual stocks, foreign exchange. Basically, as long as you have a set of data that is liquid and fairly volatile, you can use our indicators on there. Jan, yeah, you know what? I did see your trial come through. I will make sure that we get you the Kase Bars. I will make sure that we get you the Kase Bars. Chris, thank you very much. Glad you were able to join us. Leon, let's see. I have the course and do use Kase Bars with the TradeStation. Does T still allow your indicators? Yeah, we do have them there. So basically the Kase bars, it's just a bar type. So you're asking how the Kase bars are formed. So it is just a bar type. So getting into William, thank you very much. I really appreciate that. Yes. And Leon, I'll get back to your question about the Kase bars and how to build them in just a second, because it's a little bit of a complicated answer. William, the plots that we have, so all of the signals are available as a God, I can't think of the word right now, and here I am, a programmer. They are all available. The plots are all available for you to use in the strategy builder in NinjaTrader. Okay. So as far as the Kase bars, the way the Kase bars are built, ideally you build Kase bars with tick bars, one tick. So what happens is as each tick comes in, you have a target range, let's say 25 cents. So 25 cents like we were looking at, or 25 points, or whatever you want to call it. So in the case of like the crude oil contract, we were using 25 cents at one point. So as each tick comes in, you look to see, does this bar that's currently forming exceed the 25-cent target range? If that tick is going to make that bar exceed the 25-cent target range, that tick will start a new bar. However, the challenge was when we were creating the Kase bars, the biggest challenge was the tick bar, or you could only get like 30 days of tick data. So that's not enough data to do back testing and everything else. And sometimes it's not even enough to initialize your indicators. So we went ahead and decided that we would go ahead and use 1 minute bars, which was the lowest bar length that we could get to at that time. This was around 2005, 2006. That was the lowest bar length where we could get, 10 or 15 or 20 years of historical data. The challenge with the 1 minute bars, the 1 minute bars work fine, but the challenge is that 1 minute bar, as that bar is forming, once that 1 minute bar closes, if it makes that bar exceed the range, it's going to start a new bar. Well, the start of that opening tick of that new bar isn't necessarily going to be the opening tick of that minute. It's generally going to be near the close of that minute. So what happens is, you can use a lot more historical data using the 1 minute bars, but the challenge becomes when you're using the 1 minute bars, the opening tick of a new bar isn't always necessarily the true open of that bar. So what happens is when people backtest and do things, they will see a difference in the backtesting using the 1 minute versus the one tick. And that's because of that basically kind of synthetic delay that's being built into the Kase bars when you're building the bars with 1 minute. So if you have lots of tick data, the ideal way to do it is to build the Kase bars with tick. And that is an option. You can choose either tick or time-based bars when you're building them in NinjaTrader. And yes, you can definitely use them with E-mini S&P. Kase X is the same price, $195 per month. We'll also offer the $18.95 for the Kase X if you choose to use it. So it looks like we're going to be ending the webinar now. I appreciate you all. Again, thank you very much for joining us.
All right. Thank you very much, Dean. Thank you for taking the time to go through that with us here today. If you did enjoy today's session, we do hope you'll join us for future webinars. Follow us on social media for alerts about upcoming events and other NinjaTrader ecosystem news. We'd like to remind everyone here that the information provided in today's session was that of Kase and Company and not of NinjaTrader. All information was for educational purposes and should not be construed as trading advice. Enjoy the rest of your day, and we hope to see you in future webinars. Happy trading from all of us here at the NinjaTrader ecosystem.